See, this is just a call to order for the retirement subcommittee meeting dated February 1st, 8 a.m. First item on the agenda will be a review of the minutes. Any comments on the minutes?
No.
No comments? Do I hear a motion to accept the minutes?
This is Tom Potter. I'll move to accept the minutes.
And a second?
Second, Todd.
All right, all in favor? Aye. The next item up on the agenda is pensions plan and OPEB fourth quarter performance review and governance update.
Right. I think I get started typically. I don't remember, Melissa, our protocol. Did you share the screen at the last meeting and we scrolled through it, or would you like me to?
I did, and we can do it either way, whatever you're most comfortable with.
Either or, if you want to bring it up on the screen, that'd be fine. Well, we can kind of highlighted pages here. We just scroll ahead to the very first page in the content here, just for the as informational purposes for the board. If you scroll ahead, you'll see there just a firm update. So I think, as everyone knows, right, we had back in March of last year joined forces with a peer firm out in Chicago, DeMayo Schneider and Associates. We're pleased to report that merger is fully complete now, and we're largely integrated and have made great headway there. And in kind of the maybe a perverse kind of way, it's the effect of the pandemic has actually accelerated a lot of this, because we've obviously had time not being in cars and on airplanes to really focus on integration and whatnot, and things have gone particularly well. So we're pleased to report that. You'll see we're just shy of $200 billion of assets collectively across what were the two individual firms now combined, and continue to provide advisory services really across a broad array of a clientele, as you see there, retirement plans, endowments, foundations, research engine for lots of RIAs and financial institutions, and then a pretty big private client practice as well. And along the way here, we have not stopped in terms of staffing and resourcing the firm. You'll see we continued to add folks throughout last year. Won't linger on here, but some accolades that certainly we're very proud of in terms of some rankings and whatnot, and best places to work, for example, for money management, among some others. And then if to the extent people are inclined or need access to resources, if you get to our website, you'll see all kinds of podcasts and research and analytics. And we'd certainly encourage you, if you're inclined, to utilize those resources. So I think, Melissa, that's it in terms of update on the firm level. Tyler, anything you wanted to add on that front from your side?
Nope. DC represents about 120 billion, and we've been, as Chris mentioned, accelerating that integration and the governance calendar, all that integrated, and so the services that you'll see won't likely change very much. So only improve.
Right. So if we, Melissa, jump ahead here, just in terms of context, before we get to some of the performance details itself on the plans, and then as Kevin mentioned, the governance content, which this quarter is asset allocation focused. If we scroll just quickly, Melissa, to the next page, just a little bit of context on markets. I think, as this group well knows, Q4 was another good quarter in the markets. Here's a schematic that plots global equity returns through the quarter. And you can see through some fits and starts, generally the upward trajectory for equity prices, and really following suit as you would expect, right, without a teasing through each and every one of the highlights here that we show, but really kind of related to the fate on the healthcare front, as you can imagine, right, and surmise. And to the extent we think markets on a go-forward basis kind of continue to are somewhat beholden, right, to the ability to get the vaccination distributed and get the economy fully reopened again. And generally, markets and investors have been guardedly optimistic about the kind of the fate and pace of those efforts. And then moreover, behind the scenes, as you all know, there's still tons of both monetary and fiscal stimulus that is encouraging investors as well. And I know, as you've seen more recently, thoughts in Washington that there's some form or fashion of a second wave of fiscal stimulus coming. So we'll obviously keep tabs on that. If you convert and go, or you convert this sentiment into numbers, if you will, if you go, Melissa, to the next page, you'll just see there's a host of returns here. We certainly won't go through all of them, but if you kind of work your way up and down the page for the quarter, maybe starting in the middle, if you can make it out, you'll see there how robust returns were in the equity markets. For example, the S&P up 12%. Small cap stocks, as you probably all know, have been on quite a run. We're up over 31% in the fourth quarter alone. And international stocks we're certainly encouraged by, have done well also. Interest rates have been reasonably well behaved. They bounced around a little bit in the quarter, and we'll show you a visual on that in just a minute. But the broad markets were up a touch. You see there in the upper left-hand corner of the page about 70 basis points, or roughly 0.75%. So the backdrop was pretty broad in terms of returns and markets kind of functioning and working. Again, for the reasons previously mentioned. If we could, Melissa, scroll ahead here. We've got lots of charts and graphics, and we certainly won't go through all of it, but I think there's a couple worth highlighting if we go to the next page. If you can scroll up just a touch, you'll see there. Let's see if we go back just where are we? My page is, I apologize, my page is jumping around a little bit here. Yeah, why don't
Sorry,
we?
probably a little bit of a delay. Was it?
I'm sorry. This page is okay. I think the previous pages just showed some of the macroeconomic data, and again, it's encouraging in the sense that expectations for GDP growth next year continue to be positive this year, kind of accelerating in the back half of the year. So that's all we need there. The takeaways on this page, I think the most important takeaway here is on the bottom half of the page. And maybe kind of under the hood, the most interesting and perhaps important thing that happened in the quarter was we had much greater breadth in returns in the fourth quarter. And you see on the bottom half of the page, right, we talked about in previous meetings last year, markets regaining their footing after March, but really a lot of that concentrated in U.S. large cap equities and moreover growth equities, at that. What's interesting on the bottom half of the page here, you'll see is the much greater breadth in the markets, and whether it was small cap, value as a style, international equities, all kind of having a somewhat of an upper hand in the quarter versus U.S. large cap. And that's encouraging for a whole host of reasons. One, obviously, it helps for diversified investors like yourselves. We'll see that momentarily. And then moreover, oftentimes, the greater breadth in the markets has historically been a precursor to, the next leg up, if you will, in the economic regime and the next economic cycle. So, should that pattern hold true, it could be foreshadowing, more steady momentum in global the global economy. And obviously that would work on a whole host of fronts for everyone. So just something to be mindful of under the hood there. That greater breadth was something that got a little bit lost in the shuffle, I think, for a lot of folks as the year came to a close, but I think a pretty important distinction. If we scroll down, Melissa, just a little bit on the fixed income markets here, we won't spend a ton of time, but you do see what I hinted at earlier in the upper left-hand corner of the page. Rates did move out a little bit in the fourth quarter. You can make it out there. You'll see kind of the beginning of the quarter with the yield curve expression down at the bottom of the three. And then you see the end of the calendar year 2020, and you see on the back end of the curve, if you will, call it 5 years and out in maturity, you see interest rates moving up a little bit. Appetite for risk was as prominent in the fixed income markets as it was in the equity markets. So you do see incremental returns for high yield and corporate bonds. over and above treasuries. So, that kind of insatiable appetite for yield that investors have had now in an otherwise very low interest rate environment continued pretty it was unaffected by any goings on in Q4 and kind of remained in play. And you see that evidence visually in the very lower right-hand corner of the page in the graph on the bottom, where we plot spreads for you. And you can see, again, that kind of continued march tighter in spreads, both investment grade and high yield. So investors continue to feel comfortable taking risk on the fixed income side as well. So I think that's probably a pretty good run through just markets at a high level before we transition over to governance, and then of course look at the portfolios. Is there anything from the committee, just kind of larger, bigger picture, economic or market wise, that you'd want to kind of highlight here or hit on that I missed before we transition over?
I had a quick question.
Sure.
Can you speak to what's happening with Reddit? Do we think that there's, are you any concerns?
Yeah,
Does it impact us at all?
I'd love, Lisa, to tell you that we had the inside, scoop on what's going on with Reddit, but we don't, probably, other than what everyone else has been reading. I think, as everyone knows, right, smaller investors have been using a variety of platforms oriented towards the retail investor to try to take positions, and successfully so to date, against some of the big hedge funds that make their money shorting stocks. And you've certainly seen a complete departure from fundamentals in some cases, as GameStop being the most prominent example of a brick and mortar outfit that's hard pressed to think it's going to continue in any form or fashion, and certainly wouldn't be valued on the fundamentals to where it's trading today. But kind of the technicals in the market and what these individual investors have been doing is I don't know. I don't think it has, Lisa, any kind of broad long-term implications, right, for the way you invest. It's hard to kind of grasp, right? Because it's not true price discovery. It's just literally people, kind of trading stocks, again, away from the fundamentals. So I think it's something to kind of monitor. I suppose, it's something to be mindful of, but I don't think, particularly for the way that your plans are invested, right, on a much broader scale and diversified scale, that it's anything that, ultimately, right, grinds the gears in terms of the liquidity of markets or functionality of markets, right? I think it's just one of these things like Bitcoin or, there were fads, remember, back in the original technology crisis, some of the internet companies, overnight, that were valued at $1 billion that didn't have any sales or whatnot, and had just, put a website up on the internet. So, maybe,
right. Lisa, I'll kind of answer the question as well. When I first got into the securities business, one of my mentors told me that the games don't change, just the players do, right? So this reminds me, as Chris has said, 97, 98, when you had the Yahoo chat rooms and people were out there talking about the stocks. Reddit is no different than the Yahoo chat room from 98. But that's my opinion. This is just new players are in the game using a slightly different technology.
No change in course for us. Steady on.
No change in course, Lisa. Certainly not. So we'll keep you posted on that here. So if we, absent any other questions from the committee, if we scroll ahead, we should probably, if we could, Melissa, we'll jump ahead of some of our other themes here and information. We'll leave that to the committee at your discretion, if you're inclined to look at that. If we jump right ahead here into the content, so as mentioned, the governance this quarter is asset allocation, right? So if you all remember, this is kind of where we step away from, if you will, the day-to-day investment stuff, and we're just looking bigger picture at the return potential of the portfolios as they're currently allocated using our latest capital market inputs. So it's a little bit new and different this year for the group from previous years is we've combined forces, again, as mentioned, with DeMeo. We formalized kind of the efforts, if you will, even more so than we had just on our own, in the sense that we've got a capital market working committee. I'm a member of that. And that group is charged with really on a building block basis, kind of creating inputs, capital market assumptions across the major markets and forecasting those so we can kind of gauge the portfolio's earnings potential on a go forward basis. So that's really in kind of a nutshell what is the next several pages kind of highlight. If you scroll, Melissa, down just a little bit, this was information you've all seen already, right? We just recataloged across the 3 plans, funded status and return assumption. You might remember when we last convened, we had done a survey statewide of CAFRs. And interestingly enough, that the Simsbury plans looked very much like the state averages, both on a funded ratio basis and moreover on the standing return assumption of 6 3/4. And I think as we talked about, right, as we kind of get into this new cycle, our suspicion and at least the scuttlebutt we're hearing statewide is that we expect probably the next time we were to do a survey that return assumption statewide is probably a touch lower. I know a lot of people, at least with clients I deal with statewide, have been working in similar allocations to the towns to that mid 6s range, so 6.5 kind of being maybe a new landing point, but obviously something I'm sure that you folks will discuss through time with Becky and the team at Milliman. So anyways, just we recatalog those. This is information you all know already. If we jump down a couple of pages, Melissa, will actually begin to have the output from the analysis, just in reaffirmation here that the plans are well within the ranges that you've specified via the investment policy statements. So nothing to do there. And then if we skip ahead to the very next page, we start to unfold. I had mentioned, I think probably on a summary basis already, the process, some of the inputs here that, again, I think I'll leave to the committees, review those at your leisure here. But I think the factors and the inputs here are things we've all touched on a little bit in terms of the initial comments. The big takeaway you see here visually, right, is year over year, no surprise, right, that return assumptions are down. It's kind of funny. The last 3/4 of last year, in a way, kind of increased the hurdle, right, as we had that big ramp up again in capital market prices. That has implications, of course, on a go forward basis for our assumptions, and all things equal, right? It does push those longer term assumptions down a touch. So again, we're not going to go through all this, but I would highlight a couple. You'll see global equity, our forecast is about 7.7%, our long-term forecast. You see bonds there, a little bit north of 2%. Right. So these are numbers that are lower than they've been in quite some time. And obviously, again, that puts a little bit in the way of pressure on forecasted returns. So if you skip ahead, Melissa, if you could, we just pulled the summary here. So this is probably the biggest takeaway for the committee and where we'll focus just a minute for you. So we took the existing allocation for the 3 plans. You see that in the blue highlight there in the upper left-hand corner of the page. You'll remember the portfolios, right, are roughly 2/3 equity and real asset and 1/3 fixed income. And then we further delineate it, you'll see there, across the underlying mandates and strategies. And we arrive at a modeled return, and you see that number 6.4% on an annualized basis as being our median expected return over the forecast period. And then what the analysts do is, you see there, they just out of the system build a plus and minus 50 basis point mix to kind of bracket where you are today, to just give you a little bit of sense of, kind of up and down the risk return spectrum, if you will, what the portfolio could or may look like. So the portfolio today, in our kind of best estimate on a go forward basis, absent any contribution from the managers, which, as we all know, has been a tough road more recently. 6.4% is our best estimate of what the portfolios are potentially are able to do over that longer term on an annualized basis. So, so you're in you're in the realm, if you will, right? Kind of where you are today, and I think where you're contemplating, but maybe a touch lower on just the modeled returns. All right, the obvious solution, right? How would you kind of rectify that? Clearly, right, you'd have to move to a higher equity weighting to drag that return on a forecasted basis up a touch, as I know you can all kind of readily forecast on your own. You don't need us to do that. So let me pause there for just a minute, because that's kind of a lot of information behind the scenes that we summarized in this single page. Happy to lend any more perspective to this information as well, if the committee's inclined.
Hey, Chris, it's Kevin. My only question is we know that the Federal Reserve is going to allow inflation to heat up, right? This is the $24 question. What changes or what portfolio analysis are you doing to prepare for that?
Yeah, so I think, Kevin, in our actual underlying inputs, right? We're over that forecast period. We are modeling some inflation into the mix, and then kind of on an anticipatory basis, what that may mean for return streams, most prominently in fixed income, right? Equities generally holding pretty well when inflation ticks higher. We're using right now, just for the committee's information, a return assumption, inflation assumption, of 1.8% over the forecast period, right? That's a touch higher than what it stands at today. I think if you look at PCE, which is the Fed's preferred inflation measure, it's about 1.4% right now. So we do offer up a touch in the way of incrementally higher inflation through the forecast period. So I think, Kevin, to your question, right, that directionally gets at the idea you mentioned, and I think is consistent with what the Fed said, right, that they may let inflation drift a little bit.
Well, I guess, the thought is that they're going to let it go above 2% for an extended period of time because they want to do an average of 2%.
Right. Yeah. So I think, right. Yeah. So we're, it's, that statement is, we don't model explicitly for above 2%. I think we're mindful and aware of it. And I think the kind of the bigger, consideration for the committee, right, is just from a portfolio construction standpoint, we're mindful across asset classes in the way you're allocated of the effect, how the portfolio should respond to higher periods of inflation. And if we want to say it's above 2%, again, a large swath of the portfolio in the form of equities should hold in pretty well in that environment, all things equal, right? Inflation is typically not debilitary to equity returns. We do have to be mindful of fixed income. And you do remember there, right under the hood, you've got things like global bonds and dynamic bonds and other things where the toolbox is a little bit broader and the managers can around kind of the fringes, if you will, set the portfolio up to defend itself, I think, pretty well, should we get a bit of a ramp up in inflation here. And then the real assets also, right, would help on the margin too, because they tend to do well in inflationary times. So again, I don't know that there's certainly not an action item we have per se for the committee, but we did want you to have in the books just a notion of where the portfolio is modeled to. Again, I'm certain there's ongoing conversations with the Milliman folks and what you folks are doing on that front. But I will tell you as a preview, because we share a lot of clientele with Milliman. I think they do some of their own analytics too on the capital market side. And so far in this cycle, reporting cycle, where we've worked with them, our numbers are pretty darn close, not identical, but pretty darn close when you look at their analysis and their expectations versus the way we kind of model. So I think you'll hear a similar message from the Milliman folks, just in terms of return potential, and then moreover, directionally, how committees and towns are responding just in terms of their actuarial assumptions and what they're doing on those fronts. So that is the update on governance and asset allocation. Kevin, I know you had that one question. Are there others from the committee before we segue over to the portfolios quickly? Looks like everyone's okay. So a representation that Melissa has a page up here, the calendar year and numbers we kind of hinted at earlier, right? That you were in good stead from a target standpoint and being relatively close. So you do see the 3 portfolios here as allocated at the end of the calendar year. Again, nothing in the form of absolute takeaway here. The one thing that I would preview with the committee for next quarter, we are doing kind of even a more intense underwriting of the Templeton Global Bond Strategy. You'll remember we'd had that at 5% of the portfolio for a period of time. It was cut in half a short while back to a 2.5% target weight. And we're kind of continuing to evaluate that manager, and we'll have more for the committee at next quarter's meeting. We still like the team there. They are still on maintain from a technical standpoint in our research group's analyses, but nonetheless, it's continued to be a touch of a struggle for them. And we want to make sure that the thesis is still there. So we'll be back to the group on that front again next quarter. Otherwise, the balance of the roster, I think, is in pretty good working order. And if we transition, Melissa, if we could, just to kind of come full circle on that, just to show you a couple of numbers for the quarter. There we go. So it was a decent quarter, you see, for the plans, up a little north of 10%. I'm in the middle of the page. The broad markets were up a touch shy of 10% in the quarter. And then you see the calendar year up just shy of 14% for the plans versus 13% for the benchmark. So, again, you're starting to see a little bit, right, that greater breadth in the markets we talked about, being, we think, ultimately beneficial, both in terms of absolute returns and certainly relative returns. So that's encouraging. And I would dare say, right, back when we had our special meeting in March of last year, I think we all would have done, cartwheels down the aisle to say the plans would get 14% in 2020 when you think about how kind of the depth of the crisis back then. But it does prove how resilient the markets had been, the magnitude of stimulus we talked about. And then moreover, just, and this group has always been great at this, I think, the discipline of staying diversified and staying true, to your asset allocation targets. And you see the benefits of that in the ramp up in the last 3 quarters of the year. So kind of all things, I think, equal a pretty solid year for the 3 plans. I do want to be sensitive to time, and I know Tyler's got a decent amount of stuff, and we do want to spend a couple of minutes on OPEB too. So I wasn't going to go into more detail on the pensions than that, but happy to answer any questions the group may have.
Question? Kevin, I had a question. Can you speak to the funding of the accounts? I think I saw in the stacks that our funding actually went down. Is that a reflection of the amount of people who are retiring, or did I read that wrong?
No, I think, Lisa, so I think that's the case. I have to be honest with you. I would defer to the Milliman team on that detail. But yeah, we had just cataloged from the reports, and I think that's what it is as well.
I guess Amy or is Marie on? Could you, or Melissa, if you want to speak to that? Is that an accurate assumption?
I don't know. I can reach out to Milliman, Lisa.
Okay, thank you.
Anything else on pension plans? Doesn't sound like it. Okay, great. If we, Melissa, just quickly, I'm not sure the best way to do this, and I apologize with our report, right? Because we've got the OPEB is I meant to catalog what page it is, but it's deeper into the report, of course, here. You've got to
It's
skip.
all right. I bookmarked it, so I think I got it here.
Perfect. Excellent. You're smarter than I. Here we go. So if we just quickly on the OPEB, right? If we scroll ahead here, here's the allocation construct at the end of the year. Generally pretty close to target. We're always mindful and working with Amy, of course, on liquidity, right? So that can be transitory. There may be some monies that come in that get redistributed and repurposed. As you all know, we would, other things equal, put monies to work in areas that are underweight. But when you kind of think things more broadly, pretty close here at the target levels, as you can see, particularly when you work down through the risk assets, the two big equity categories at the end of the year, reasonably close to target. And again, we're mindful of that. And to the extent there's rebalancing, we'll you obviously do that work proactively. And no changes, of course, right? Just all indexed via ETF. And so when you skip to the returns, again, over the long haul, there's a little bit of tracking error in some of the ETFs on occasion, a little bit of that allocation differentiation from target, right? But again, over the long haul, you see generally the portfolio generates, right, net of fee, what the markets do. And again, no surprise here. So a little north of 10 for the quarter, a little north of 13 in an absolute return for the calendar year. And then kind of running longer term again, as you would expect, right? Akin to the markets. I think the portfolios carry something like a 19 basis points of expense or something like that on a weighted basis. So no surprise, right, where the portfolio's net to. So again, kind of just running as is, and over time they've annualized at 6.5%. And 7.5% for the 10-year period ending in December. And I think, as the committee's always desired here, just letting the markets, kind of work as a tailwind. They generally go up more than they don't, as we all know. And, the portfolio has been the beneficiary of that trajectory. So I don't think there's really much more here on the OPEB front. But again, happy to answer any questions from the committee before we jump over to Tyler's stuff on the DC side. Pretty straightforward, I think, right?
Yeah. Thank you, Chris.
Okay. Great. So I'll let Tyler pick up on the DC stuff.
Great. Thanks, Chris. Morning, everyone. If Melissa, we can go to the next page there. This quarter is our a page after that. Next, yeah, 60. Thanks. This quarter is our regulatory and legislative updates. So I'll give you a couple updates on proposals and some new DOL proposed rules that most likely will get pulled back by our by President Biden. But we'll talk briefly about that. I'll go into committee best practices. I did include the investment policy statement and did review that. It is a document from about 2014. It's still I'd say qualifies for the current plan. But I would say that, I'm sorry, Melissa, we can go back up. Let's see if we could start at page 61, that'd be great. But I'll talk about the investment policy statement. It was signed by Tom Cook back in 2014. It still applies to the plan. I'll leave it up to the committee to either sort of reaffirm it via the minutes, or we can provide a clean version and have it formalized or signed. There's no right or wrong answer. We are following the document, so I have no concerns there. And I'll go into it momentarily. From an industry update standpoint, a couple things occurred over the last month or so. The DOL issued some guidance on how fiduciaries should select social responsible funds, ESG, environmental, social, governance, investment options. President Trump and his administration were looking to have Erisa fiduciaries reconsider the selection of those investment options and follow what's considered only pecuniary factors or monetary factors when selecting those funds. And so that rule was issued the middle of January. We expect that to be reevaluated by the new administration. Again, in essence, it said that fiduciaries should not use any non-pecuniary or non-monetary based decisions to select investments. And as we work with a lot of nonprofits who offer social responsible funds, and again, that would make them reconsider the selection and the rationale behind selecting those funds. But again, I expect most of those to be reevaluated over the coming months. The one thing that is a strong consideration, given that this was a bipartisan proposed legislation, is the Secure Act 2.0. And what this would do is increase the required minimum distribution from its current 72 to 75. So that is in proposal stage right now. There's also a proposal to increase the catch-up limit. So right now, if you're older than 60, you can contribute an additional $6,500. There's a consideration for that to be $10,000. And there's also some discussion around allowing for individual participants to reallocate matching contributions to student loan payments. So for instance, if my employer was offering a match, I could contribute to a student debt and have them apply that contribution, that retirement contribution, to a student loan payment. So a lot of things within Secure Act 2.0, more to come. Obviously, this is in proposal stage, and we'll let you know if things change. And obviously, that would impact or will potentially impact plan design. If you go to the next page, Melissa, I'll briefly touch on litigation. We haven't seen a lot of litigation with respect to municipalities, but there has been an increase in over the first 8 months of 2020. It was almost 5 times more lawsuits than what we saw in 2019. So an uptick in litigation. What we're seeing is a claim against sort of actively managed target date funds versus index funds, but your T. Rowe Price target date funds are performing very well versus peers and net of fees versus the index. Failure to enforce proper cybersecurity measures. So if you remember last quarter, we did a questionnaire around evaluating cybersecurity. And so, obviously we're comfortable with both. And during the RFP as well, we evaluated the proposed record keepers around their cybersecurity controls, and we have no concerns there. What I found interesting within the last couple months, Abbott Labs was sued around a data breach or a hack that resulted in about $250,000 from a participant's account being transferred to the hacker. And what's interesting is the courts did not recognize that the Erisa duty of prudence extends to safeguarding those assets. So essentially said that Abbott Labs didn't do anything wrong, and said that cybersecurity or cyber fraud doesn't fall within Erisa responsibility from a fiduciary standpoint. But we think it's best practice to continue to evaluate the controls that ICMA has around cybersecurity. Offering proprietary investment options, and we don't currently have a significant exposure to ICMA proprietary products. Failure to follow documents and investment policy statement. We reviewed that this quarter, and we're confident that follow the investment policy statement. And then another thing that I found interesting is improper use of participant data by the plan's record keeper. So obviously ICMA is a record keeper. There's a lawsuit right now at Shell Oil that the complaint alleges that Fidelity they're the record keeper. They have the Shell Oil participants' data, and Fidelity uses that data for some of their retail investment professionals to sell sort of non-retirement products, investment products that are outside the retirement. And the complaint says that this confidential plan participant information is a plan asset, and Shell Oil's allowing Fidelity to use that data is a breach of their fiduciary responsibility. So instead of the plan assets being the money in people's accounts being a plan asset, they're actually referring to plan participant data as a plan asset. ICMA currently doesn't use that data to sell any product, so we're comfortable with this. Again, this Shell Oil lawsuit hasn't been settled yet, so more to come on that, but it will impact, I think, the industry if that rules in favor of the participants, given that there's a lot of record keeper companies that utilize that data for other things. But no concerns with respect to what ICMA is using that data for. I'll pause there to see if there's any questions.
I do have a quick one. This is Sean. Anything in the excessive fees arena?
Always around, so litigation's always been centered. So a lot of the nonprofits, for instance, the colleges and universities have been around excessive fees. A lot of settlements. So, for instance, UPenn settled recently. A lot of the Ivy League schools settled around excessive fees, and really that was around not doing an RFP in a timely manner.
Yep.
The town, obviously, we just got through doing an RFP, so I think you have some good data there to show that you've overall lowered the fees. We, of course, will continue to benchmark those fees. So I think you're positioned fairly well on a go-forward basis around the fact that you document that you've looked at fees and that those fees are reasonable.
Yeah, no, it seems to be confined to the nonprofit college arena, but the challenge is once the plaintiff bar runs out of places to go, they look for others, right? So,
absolutely, Sean. I think your best protection is that you're 13 million as opposed to 13 billion. I mean, they're targeting that larger plan space, but
absolutely,
we've had a process. I think the one risk is we've been a little bit high in fees, but that counter to that was that you had that guaranteed 4%. And so we sort of weighed the benefits, the pros and cons of having that high fee and then also having that 4% benefit. We've documented that through minutes. We've looked at and benchmarked those fees. And so I think you'd have a good, theoretically, if there was litigation, you'd have a good argument to say, hey, listen, we knew we've been evaluating this and we felt that over time, that 4% benefit outweighed the say higher record keeping costs, but we did do an RFP. Here's the documentation of that RFP, and then really significantly lowered costs in favor of the employee base.
Beautiful. I appreciate all that. Thanks.
Mm-hmm. The next page, 63, is just an overview of the Erisa responsibilities. I will say that this. Municipalities are not technically Erisa, but we like to say that we follow the sort of 5 key responsibilities of Erisa. Act exclusively in the interest of plan participants. Act in accordance with the prudent expert rule, which is essentially saying, act like an expert even if you aren't, or hire someone, which you do. Diversify those investments, which we have a good mix of investment options. Follow the documents. Which we'll talk about it today a little bit, and then obviously avoiding prohibited transactions. So, free from conflict, and again, not borrowing from the plan for other uses. So I think the committee is in good positions there. And then on 64, I put together a sort of list of best practices from a fiduciary standpoint, which I think the town follows pretty well. We periodically meet, you have a quorum, I mention every year that you look at fiduciary liability insurance. It's my understanding that every year you reaffirm that you do have that liability insurance through either E&O or D&O insurance. Periodically evaluate communications, education, advice. We did a lot of that as we implemented with ICMA. And again, I will give kudos to the internal team that ICMA transition was fairly seamless. Again, that all occurred mid-quarter or mid-January, so without any issues. So unless anybody tells me otherwise, my understanding is it went fairly well. So and again, we help you with our governance calendar around plan-related governance stuff, such as making sure fees are reasonable. We evaluate ICMA periodically. And so I think you're covered for the most part from a best practices standpoint.
Just a quick question.
Starting on page, sorry, is there questions, Lisa?
Just quick question, and this is for Amy and Melissa. Can you just confirm we have fiduciary liability insurance for the minutes?
Yes, we do.
Thank you. If our clerk could please add that to the minutes. Thank you.
So starting on page 66, I did include the investment policy statement. It was a document we helped draft back in 2014. We don't have any recommendations to change. It does reference the sort of retirement plan subcommittee. So I think the intent was that this would oversee the subcommittee's roles and responsibilities. We do keep it specific enough to outline the process of that committee, but broad enough not to paint the group into a corner. Again, it was signed by Tom Cook, obviously, who's no longer with the town. You can either reaffirm this document, you can keep it as is as a signed document, or we can provide a clean document and have it re-reviewed and signed again. I guess I'll open it up to the committee. I only say that because it does reflect it's older, and obviously it's formalized by someone who's no longer with the town. So I didn't know if it was something. That's the only change I'd have to the document. Everything else, for the most part, looks and we are following. But
Yeah, I think that's a good idea, Tyler, to put it on an agenda meeting for the next subcommittee is to review the investment policy statement, and then to put it in front of the Board of Finance for their review.
Okay. I will provide you with a Word document of that, update the date, and then obviously remove the signature, and we can just review it and have a conversation around that.
Okay.
And again, best practice is, if you were ever, typically, but if there was ever an audit, someone would say, okay, why is it, dated so long ago and signed by someone who's no longer there? So we'll get that cleaned up for you. And
yep. Amy, would you be able to just put it on the agenda or Melissa on the agenda for the our next Board of Finance meeting?
Will do.
Thank you.
So starting on page 72, Melissa, is the balances. Again, what we included is the old Mass Mutual balances, and then the updated ICMA balances. So no big concerns here. You could see we ended the year at 14 million on the 457, at about 548,000 on the 401A, and 798 in the Board of Ed plan. If you look at the updated numbers, right in line with what we saw on the Mass Mutual side. So page 75 is what we did is right at the transaction at January 12th. We included the balances at ICMA. So no concerns with the transfer. Again, as I mentioned, happened without any big concerns. Bulk of the assets still in that sort of equities, a big portion in the target date funds, and of course still a big portion in the in that sort of stable value asset class. There's obviously a lot of the new investments, such as the Fidelity Index funds, that didn't have any money at the beginning, but I expect that to continue to grow as people are aware of it. And then you can see, of course, very little in some of the target date funds that weren't available previously, but now obviously are available to individuals. The target date 5 series, as opposed to just the 2050 and the 2040. There's now the 2045 and the 2055. So if we look at the next page, we'll get into the performance. As I mentioned previously, the, uh, 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 versus the index and versus peers. So just a reminder of how you read this. It's performance net of fees on the quarter one, and then annualized on a 3, 5, and 10 year, and then it's peer ranking below that, one being the best in that for that vintage, 100 being the worst. And as you can see, the T Rowe Price for target date funds have been in the sort of top decile in the quarter 1, 3, 5, and 10. So performance has been very positive. We do have and continue to have those funds on maintain. If we go to page 78, and again, this is the new menu. I didn't see the point in evaluating the previous Mass Mutual menu, but performance still very positive. You can see Western Asset Core Plus Bond performing very well versus peers. MFS Value slight underperformance in the quarter, but significant outperformance longer term. So no big concerns there. I will touch on the next page, page 79. The Eaton Vance Atlanta Fund does have some longer term underperformance. A lot of that is from the last year. And sorry, Melissa, this is on the next page there. But the 1 year, obviously, can everyone still hear me? I think my internet dropped.
We can hear you, but I think
Yeah,
your
we can hear
video
you.
might have frozen.
Great. My apologies. Page 79, that Eaton Vance Atlanta Capital SMID cap, you could clearly see some underperformance versus peers versus the index. A lot of that's due to the sort of capital market context. That Atlanta team has had a focus on more moderate growth valuation stocks that have demonstrated a history of strong profitability, that they believe have the ability to continue to grow profits in the future. The underperformance over the last year was sort of a result of the market's rebound off that March bottom, which was driven by a lot of the sort of cyclical, low quality companies in areas that they just don't invest in. A lot of that is sort of aggressive growth technology and biotech. These companies don't have any sort of free cash flow generation or earnings growth. So in essence, they don't invest in non-profitable names. The underperformance was not based on any sort of specific stocks that they held that sort of created or caused underperformance. It's really just that they don't invest in non-profitable, low quality names. And, they believe that sort of business model isn't indicative of longer term outperformance. I think a similar market environment back in 2009 had them underperforming around the same time. So it's really a function of the capital markets as opposed to their sort of positioning and strategy. So we're still giving them some time. We have some patience with that fund. We'll consider. We'll update you as things potentially change, but no recommendations to change that fund at current. The rest of the funds are on maintain. No recommendations to change the menu. And I guess I'll pause there to see if there's any questions. And I apologize for the internet outage.
No questions, Tyler.
Great. That's all I had.
Great. I guess if there are no other questions for Chris and Tyler, I guess the last item on the agenda was research and team overview.
Yep, I can, Kevin, come back to that. If we could, Melissa, I think we had been charged by the committee, right, just to get a little sense of the group and the credentials and the experience of our research team. So our new, got it depicted here on the page Melissa has up before you is our new combined group. And you can see there it is a pretty big effort now. We had what we thought was a great team in Windsor, right? And we've combined with another great team in Chicago, and you see how that kind of fleshes out here, just a simple visual that gives you a sense of kind of who's doing what. So we do have, we think, good, capable, well-credentialed, experienced people working across just broadly capital markets and the global markets and private markets and the hedge fund arena. and just really a thoughtful, well-connected group that's, I think, got a lot of presence with investment managers, and we're able to traffic really and up and nationally, internationally, kind of large firms, small firms, everything in between. We do get a lot of foot traffic, if you will, or screen traffic, I suppose would be the parlance now, across the investment management community, and have just what we think is a really thoughtful effort in terms of the people. This is the group that's doing the work behind the scenes that Tyler and I rely on when we're talking to you about markets and the managers and what's working, what's not working, are changes needed or not. So I think hopefully you would agree, a pretty robust effort, and one that we're certainly, proud to showcase with committees like yourselves in terms of their capabilities. I don't think, if you scroll, I'm trying to remember, Melissa, here, I think we just broke out, right? If you scroll through the deck a little bit more, I think it was just, you're certainly free to talk to any of these folks at any point in time, I suppose. So don't be shy if there's someone you'd like to talk to, and we'll bring folks aboard as needed, just in terms of the process and the way things are vetted. You see here, it's a pretty, again, a pretty thoughtful, thorough approach, and we're kind of, as we've always done, looking both qualitatively at the firms and kind of what gives them their edge, and marrying that, of course, to lots of quantitative analytics, and just the process here that those different strategies, candidate strategies and existing strategies go through. You can see has a lot of input and a lot of perspective before we're labeling a manager being fit for client portfolios or plans. So that's the approval process you see indicated here. I think, Melissa, if we go through just a little bit more, just in terms of some of the cadence around the research effort, and kind of how we go about it. We kind of devote a quarter to different segments of the markets the research teams do, where they kind of do a particularly deep dive on circumstances in their markets, and again, what's working and not in their portions of the research world, if you will, and share that information in our research forums. So again, I think just hopefully a testament to the thoroughness of the effort. I think if we go down, I think that was where we had left it. So hopefully that was kind of met. I think the committee's inquiry was to just get a quick flavor for the team and how they go about things. Again, to the extent we think it's appropriate, we certainly would bring those resources in. If the committee at some point would like to talk to folks about a particular strategy or something, we're happy to do that as well. But you do see it's a robust effort and a thoughtful one with lots of guardrails and lots of analytics, and of course with the necessary scale, we think, to make sure again that we're delivering to you the very best ideas in the marketplace. I don't know if that asserts the purpose, Mr. Chairman, but that's all we had in terms of overview. I don't know if I had folks had questions on that or not.
Yeah, no, very much. Are there any questions for Chris? We appreciate the update. All right, that was the last item on the agenda. Any questions, any comments before I hear a motion? No. Hearing none. Tyler and Chris, again, we appreciate everything that you do for the town. And we appreciate it. Can I hear a motion?
I move to adjourn the meeting. This is Tom Potter.
Do I hear a second?
I'll second.